Hi everybody, this is Vijay Bambani and I welcome you to the fourth edition, the video edition of our free weekend market newsletter, which we have christened Mott's Musings. I hope you enjoyed the first three editions, and I also hope that you are benchmarking the levels that we are providing in these newsletters and whether they are holding out fairly accurately or not. I would love to hear from you, and do keep providing your feedback. Use the comment section to let me know what you think and how we can basically progress from here onwards. So I begin this week's edition with continued caution, which I did give you last week also, about trading on fairly light exposure because the market beta, which is the volatility, the statistical volatility, is expected to remain high. Here again, I expect volatility to remain high going forward, so the caution remains in place. And I begin with a market roundup, which you're seeing on your screen. So the Nifty rose 1.43% on a week-on-week basis. The Bank Nifty gained 4.02% on a week-on-week basis, which means it outperformed the Nifty 50 in relative comparison. Gold went up 0.58%. Silver on the MCX rose 1.25%. Oil fell 1.87%, which is a positive for countries like India, which are import dependent on oil. Natural gas, on the other hand, went up 6.5%, which is a slight negative, but then this is a function of winter pricing. The USD INR rose up 0.31%, which is actually negative, as I have been pointing out that emerging markets, including India, would want a stronger local currency vis-a-vis the US dollar, because we tend to be import dependent and everything that we import becomes more expensive if the dollar goes up. The other thing that I feel is a cause for concern is the 10-year benchmark bond yield, which you're seeing on your screen. It was 5.92% last weekend and it's fallen to 5.88%. Now this is something that I will discuss in the 10-year benchmark bond yield segment, which follows the immediate roundup. The market-wide position limits rose to 36.93%, which you are seeing on your screen, because the trader expectations continued to remain firm, and the chart tells you that traders, even though are preparing to gear up for the expiry coming next week, are not in a mood to let go of their positions. The volumes also tell you a story. The index futures volumes, as you can see on your chart, collapsed, whereas the stock futures volumes actually zoomed to a 19-day high on the chart that you see on your screen. So the action was clearly on individual stock futures rather than the indices, which are basically facing selling pressure. I would draw your attention to the chart on your screen right now, which is the basis, the futures versus the spot prices of both the Nifty 50 and the Bank Nifty. You see, the basis on both these counters has come down on a week-on-week basis. The reason being primarily selling pressure at higher levels, and B, we are now looking at the expiry of the October futures in the coming week, which means the cost of carry, or the difference between the current month futures and the next month futures, along with the premium of futures versus the spot, will basically contract. So as you can see, the basis chart is also telling you that there is selling pressure and the difference in the futures and the spot is falling. I now come to the 10-year benchmark bond yield segment. Being an old school trader, I follow the bond markets extremely carefully, because this is a bit of information, a bit of market clues that you cannot really forego. And as long as it's there, you might as well use it, because this market is the fountainhead of the money supply. What it basically implied last week, as you will see on your screen, is that the 10-year benchmark bond yield, which is the government guaranteed bond, saw the yield contract to 5.88%. Now, this basically tells you that bonds witnessed a huge amount of buying. And since the bond prices went up, the yields contracted. Now, this is not welcome. This is not a good news. Banks are rushing to the safety of government guaranteed bonds rather than lending money to businesses. And it also tells me that they are not expecting a rate hike anytime soon. Even the rising CPI, the retail inflation for September, which hit 7.34%, basically is not triggering a rate hike, which has also been a factor why banks are running towards the safety of the bond market rather than lending money. As long as bond yields are falling, I expect equity markets to face a little bit of a caution. And do watch this bond yield every day. I put this up on my social media pages. Feel free to connect with me. I've given you the contact coordinates at the end of this video, wherein I put up all these figures and data points post-market in the late evening. The other factor that bond yields are getting influenced by is the fact that the USD INR, which is the United States dollar versus the Indian rupee, has been firm. Now, if the Indian rupee is easing against the dollar, everything that is imported, like I told you, tends to become a little more expensive, and therefore the rising dollar tends to be inflationary for India. It results in what we call imported inflation. I now take you to the US dollar index, known as the Dixie. Now, the Dixie fell on 4 out of 5 trading sessions last week, as you are watching on your screen in the chart, and it ended the week with 0.98% losses. And as I mentioned in my previous videos also, the pre-election pattern has failed in this US election cycle due to the COVID pandemic, as well as internal factors in the United States of America. The weak dollar index, or the Dixie, is actually good for the emerging markets, which includes India, and it's bullish for bullion as well. I think you need to keep your ears to the ground for the Dixie and watch out where it's going. And in the coming week, I expect an estimated range. I emphasize on the word estimate. I expect an estimated range between 94.10 on the upside and 91.40 in case of declines. The days that you should watch out for in the coming week, which might influence the prices of the Dixie due to the economic data release schedule, will be all through 26th of October to 30th October, because the US markets are witnessing data releases every single day. With the Dixie done, I now bring you to the Bank Nifty. I draw your attention here, and the Bank Nifty in the last week actually rose on 3 out of 5 trading sessions. It gained 4.02%, which means it relatively outperformed the Nifty 50, as you can see the chart on your screen. It may also continue to outperform the Bank Nifty, relatively speaking, depending on whether follow-up buying action is coming in or not. The week prior to the last, the Bank Nifty was number 3 on the most volatile list, but last week it rose to number 2, which means volatility on the Bank Nifty has gone up, which means it's going to become a little more challenging to trade this index, and traders need to exercise abundant caution, cut back their exposure, and trade light. Last week, I advocated a range between 25,100 on the upside and 21,975 on the downside, which held. And the 31st August high at 25,232 remains the level to watch out for in the coming days as a short-term immediate resistance. And the coming week may also see an estimated, I repeat the word estimated, range between 26,000 in the upside and 22,950 on the downside. The days that you need to watch out for in the coming week, which might influence the pricing of the Bank Nifty, is 30th October due to India-specific data being released, which you are seeing on your screen right now. And this data might just influence the pricing of banking stocks, which in turn will impact the Bank Nifty. Let's now shift to the Nifty 50, the most liquid counter on the NSE in the futures and options segment. And this index actually managed to log gains on 4 out of 5 trading sessions, unlike the Bank Nifty, which rose only on 3 out of 5 trading sessions. But the percentage gains were only 1.43% on the Nifty 50 versus 4.02 on the Bank Nifty, which means the Nifty 50 actually underperformed the Bank Nifty. This is something that I had indicated last week also. Also remember, last week I had advocated a negative divergence between the price and the RSI on the Nifty 50. There you have it on your screen. The Nifty 50 is making higher highs, but the RSI is actually making lower tops. This is called negative divergence. This negative divergence, by the way, still remains in place, which means caution on the Nifty 50 still needs to be exercised. This negative divergence is likely to keep the bulls under check, and the other factor that catches your attention as you watch the Nifty 50 chart, which I have zoomed for you on your screen now, is the very large red color bearish candle made on 15th of October 2020, which has a peak of 12,025 and a bottom of 11,661 in the spot segment. All the following candles made on the succeeding days are contained within this prominent large red candle. Now, in Western technical analysis parlance, these are called inside days. Now, all the trading sessions after 15th of October have turned out to be inside days, which means the activity on the Nifty has been subdued. It's been kept compressed like a spring. Now, when you let go of this spring, it will bounce. Now, which way will it bounce will be determined by whether the Nifty 50 breaks out above the 12,025 or breaches the low of 11,661, which is the low of 15th of October 2020. Also, remember that this breakout or breakdown is coming in the expiry week, which traditionally has been a high beta week, which means volatility is likely to be extremely elevated. The RSI negative divergence, which I pointed out to you, is still in place, and the other third factor that you need to note on the Nifty is the megaphone formation, which means the higher trend line is rising, the falling trend line is indicating lower tops and bottoms. Higher tops, higher highs, lower tops, lower highs, lower lows, which means that the range is actually expanding, which calls for a probability of higher statistical beta. That's going to hit the traders because large price moves can occur very, very suddenly. In the week prior to the last, Nifty was number 7 on the most volatile list, but last week it was number 13. This is not to say that volatility on the Nifty has gone down, far from it. The volatility on the individual stocks has gone up because remember the traded volumes on individual stock futures is at a 19-day high rather than the index, which is at a low index futures volumes. The range I advocated last week was 12,200 on the upside and 11,300 on the downside, which held perfectly. The next week, I expect an estimated range. I repeat the word estimated, 12,350 on the upside and 11,500 on the downside. The 25 period exponential moving average is at 11,685, which will be a short-term support. Remember, that this almost coincides with the low of that big, huge red color candle made on 15th October. So 11,600 to 11,675 odd levels are turning out to be an extremely critical support level to watch out for in the absolute near term, which is the coming week. I think you should continue to trade extremely cautiously, extremely lightly, so as to avoid any untoward shocks to your capital. I now come to the final segment of this weekend edition, wherein I give you 5 stocks for high beta, low exposure traders who will basically take smaller exposure on these stocks and expect larger price move, and 5 stocks in the low beta, low impetus segment, wherein you will take high exposure, wait for very small price moves and exit the trade. So the high beta, high impetus stocks are led by Britannia at number 1, number 2, Godrej Properties, number 3, SAIL or Steel Authority of India Limited, number 4, DLF, number 5, Power Grid. The low beta, low impetus stocks are led by Z Entertainment on number 1, number 2, Infosys, number 3, Balkrishna Industries, number 4, Canara Bank, and number 5, SRF Limited. This brings me to the end of this video edition of our free weekend newsletter. In the comment section, I would welcome your feedback, and do let me know what you think of this video. If you agree with what you saw, if you liked what you saw, feel free to forward this video to your family and friends. Here are my contact coordinates on your screen right now. I'd love it if you connect with me on social media. Let's get conversations going. I put up a lot of stuff post-market, late evenings every day, and you can feel free to monitor the post-market data going ahead. I wish you a very profitable week ahead. Vijay Bambani signing off for now. Thank you for watching my video. Do take good care of your trades and investments. Bye-bye. Thank you for watching.